Hello, everyone. My name is Aaron Dubnikoff. I'm Managing Director of Sales for Arrow Capital Management, covering advisor teams in Manitoba and Saskatchewan. I'm hosting this call today live from Winnipeg. Assisting us today is my colleague from our Toronto office, Colin, and we are joined by a number of our Arrow Capital colleagues, as well as just over 100 advisors and associates from coast to coast in Canada. The last time we had Ted Whitehead on a national call was in May of 2022. And I was just looking over my notes before the call began from that meeting. And at that time, the prominent headlines were COVID recovery, rising rates, inflation, war in Ukraine, and market volatility. And when we fast forward to today, the headlines are very similar. Perhaps COVID has kind of taken a backseat, but it's still there. We just had an interest rate increase yesterday. Russia is looking at adding additional soldiers to their military. Inflation is still a concern. And of course, markets are continuing to be volatile. So all of us on the call would agree that 2022 has been a challenging year in our business, whether you are a portfolio manager, an advisor, or a retail investor. So once again, our timing is good to be able to hear some thoughts from a portfolio manager who has historically been able to do an outstanding job to reduce volatility while providing excellent returns for the unit holders of the Exemplar Growth and Income Fund. Today's presentation will help you recognize that Arrow Capital is very well positioned to help you and your clients navigate through what will continue to be a very challenging year. Before I turn the call over to Ted, I'd just like to ask Colin to flip to slide 4. I just wanted to bring your attention to a couple of points regarding some of Arrow's other mandates. First, the Exemplar Global Growth and Income Fund was launched at the end of 2021, and we are close to our 1-year anniversary with the fund. At that point, we'll be able to start publishing performance, and so far, the performance has been very good. The fund is similar to the Growth and Income Fund, and as the name implies, has the ability to be more geographically diverse. Secondly, I'd like to point your attention to our Liquid Alternatives Fund. This chart is showing performance as at the end of August, but I took the liberty to take down the performance up to the end of business yesterday, and we're very pleased to see that the Arrow Canadian Advantage Alternative was up 2.46%. The Arrow Global Opportunities Alt was up 2.76. The Arrow Global Advantage was down very slightly at 1.17. And the Arrow East Coast Income Advantage was up 0.19. We think it's important for you to notice that we've got some terrific other mandates available in the lineup. And we will be hosting a liquid alternative webinar on October 13th, where we will be providing more details on these mandates. In the meantime, please reach out to your local Arrow representative, and we would be happy to provide you with more information. Most of you are familiar with the Zoom format. We will have some time to answer questions at the end of the presentation, and we will do our best to get to as many of the questions as we can within the hour. So without any further delay, it is my pleasure to turn the call over to Ted Whitehead, Portfolio Manager of the Exemplar Growth and Income Fund. Ted, you can take it away.
Okay, thanks a lot, Aaron. And thanks to everybody joining the call today. And yeah, we'll try to make this as quick as possible and cover a lot of ground. Okay, on the next slide, Colin. Yeah. So we're going to go through our overview, just how our process, summarize what happened in the first half, and what to expect in the second half. Next slide. Yeah, I found this statement more appealing in the sense that it mentions risk management. And really that's what we're trying to do. And we all know every day we're faced with a number of hazards and things that really are unknowns that become knowns. And it's up to us to analyze or evaluate and risk and manage the risk of the different things that hit us every day. So the next slide. This is probably one of the most important slides today, even though in the past, we kind of glance over it pretty quickly. So coming out of a recession is quad one, and typically PEs expand because that's a period of time where you have growth, but inflation is mild or non-existent. Quad two is where growth starts to cause inflation. There's more demand, and so supply is not enough to meet demand. So things tend to both grow and both go up, both in inflation and growth. And that's typically when the Fed or central banks tend to hike rates. And then it's that hiking of rates that leads to PE contractions, and inflation continues on, but the hiking of rates leads to a slowdown in growth. And then lastly, in a quad four, you have inflation and growth decelerating, and at some point the Fed begins to ease rates, and then the cycle starts all over again. So what we had last year was a quad two, where we had growth and inflation accelerating. And then in the first half of this year, we've had quad three, where inflation continued to accelerate, but growth started to roll over. And when we talk about growth, we talk about in real terms, so not nominal terms. And as you know, like in real terms, the first 2 quarters in the US were negative. So that typically would say that we were in a recession, but that hasn't been declared yet. So then for the back half of this year, we're looking at a quad four scenario where inflation and growth are rolling over. But as you see on the diagram here, that's typically when the Fed is supposed to ease rates, but they're hiking rates. And so this is why we're having this bigger correction or than normal in the marketplace, and that we think it's still more dangerous in the equity market at this time than it typically would be in a normal quad four. So let's get into it. Next slide. So these are typically what tends to perform in the different quads. Like, for example, in last year, equities and credit would do well, and you want to be underweight fixed income, and it's the tech, discretionary, and industrials that tend to do well, whereas the defense sectors underperform. And in a quad four, it's typically the other way around. The defense sectors like utilities, consumer staples, healthcare, and REITs tend to outperform, and fixed income tends to do well. But as we know, both fixed income and equities have had trouble this year. And within the equity sector, what we've substituted out is REITs are at a very low rate, and we've kept our energy weight much higher, and it's our second biggest weight. And that is due to the circumstances that we're facing in the marketplace that make this quad four a bit different than others. Next. So this just gives a breakdown further into factors as well as more securities or more asset classes that do well or do poorly in those specific quads. But as I say, this quad four is not your typical quad four, and it's due to the Fed is raising rates in a time where it would normally be lowering rates. Next slide. So these are some of the things we use to help us with trading signals. I've gone over them in the past, so I won't spend too much time. Maybe just briefly on the VIX. Sub 20 is generally bullish for equities, and for the most part of this year, we've been in the 20 to 30 range, so it's been very choppy. The peak in the VIX was actually, I think, January 24th of this year at around 37. What's been missing, maybe you see in my weekly commentary, is that we kind of keep expecting 35 to 40 on the VIX at some point this year. And I'd say the reason it hasn't happened is really it's 5 or 6 stocks that are a big part of the S&P index. And those stocks to date have been fairly benign, like whether it's Tesla or Apple or Microsoft. But I think those are the ones that are going to be more in trouble in the back half of this year. Next slide. So to summarize the first half of the year, we would call that a stagflationary environment. The war in Ukraine set off a commodity spike, which has since eased off. Oil prices spiked to 130, or maybe it was a little bit higher, and now we're sitting at in the low 80s. The China COVID zero policy has not been very much help for solving the supply chains, and they intend to continue that on into the first quarter of next year. So that'll still be causing some issues. Rate hikes are not just happening in North America. It's a global fight against inflation. So the outcome was equities down, stronger US dollar, higher yields, oil prices up, gold flat, credit spreads up, financial conditions tighter, and the VIX, as I mentioned, peaked early in the year in January. Next slide. So here we just summarize the asset classes and their performance. And really, there wasn't too many places to hide in the first half of the year. Energy funds obviously would have done really well. They were the only part of the market that went up. It was pretty much broad-based down across bonds and equities. And the other area that did well was US dollar index, up almost 10%. And when the US dollar goes up over 10% within a year, that tends to lead to other problems and other breaks in the economy, and usually globally. So maybe we can talk about that a little later too. Next slide. So this just goes through the S&P 500 and the different sectors. And as you can see, in the first half, the energy sector was up 29%. Second was utilities, and then it starts dropping off. And you can notice infotech, communications, and consumer discretionary were the big drag on the market, as well as real estate. So as I mentioned, typically real estate does well in a quad 4 and a quad 3, but it is coming under the wheel because of the pricing of the underlying real estate is getting impacted by the front end of the curve going up, or the Fed funds rates going up. So cash flows are discounted back, are worth less, and just the underlying building is worth less, which is partly due to, I guess, the change in people's behavior of work from home. Next slide. So it's all about the second half and what's going to happen from here to the end of the year and what happened in the summer. So we would call this a disinflation environment. I know it seems kind of strange, but we feel inflation probably peaked in the US around 9.5, and we're starting to come down. There could be some stickiness to that, but likely to come down. We can talk about that later. Strong US dollar to continue until it doesn't. CAD lower, 10-year yields. This has been our nemesis, but we think we're going to see a peak in 10-year yields. Oil higher could be a situation after the end of October with the strategic petroleum reserves, like they're releasing every day, and that's going to come to an end at the end of October, just in time for the midterms. Volatility is to remain probably within the 20 to 30 range. Financial conditions to remain tight. credit spreads widen, equities could do better. We'll talk about that, and gold higher. So let's get into the nitty gritty. On to the next slide. So this is the forecast put out by Hedgeye. And as you can see, it's in decline since the fourth quarter of 2021. This is the real GDP. And it's going to continue to go down even into the second quarter of next year. But it does start going down at a lesser rate. And that does have some implications where the market will probably be flipping between quad 4 and quad 1 throughout the next year. And I say that because data will come out and make things look, oh, maybe it's not so bad. And then things will come out and think, oh, we're in a recession. Next slide. This is headline CPI. And again, this is in a downward slope from Q2 and all the way to Q3. One of the other services that we use has queued to 23 inflation getting below 2%. So this will be something we have to keep an eye on. And even if you listen to David Rosenberg, he thinks by Q2 of next year, inflation is actually negative. So maybe these numbers are a little high, but we're going to go with this because it tells the tale of what we're interested in, is that inflation is decelerating. Next slide. So you can see it's on the line, Q3 of this year, or sorry, yeah, Q3, Q4, all the way to Q2 of 2023. But growth or inflation is coming down a fair bit. That's, I would say, a guarantee, if you want to say, call it that. And growth is marginally coming off. And so, as I say, it's possible maybe we have a month or a month of each quarter or something like that where we flip into quad 1. But for the most part, the trading will behave, I believe, as a quad 4. But you will get these, as we saw in the summer, these counter trend rallies, which can, you know, as they say, bear market rallies can rip your face off. And for us, it wasn't that pleasant in July and August. So we'll try to do a better job of participating on the up in, we see some rallies in the next few quarters. Next slide. So just from a generic overview, we are in quad 4, which means you want to be partially invested, typically overweight bonds. That really hasn't been working yet, and underweight equities. That definitely has been working this year. So the next slide. But if you take a look at the forecast for the fourth quarter, it's a quad 4 everywhere. So I'm of the view or opinion that we did have a low in June, and we're probably going to set a lower low in the fourth quarter. But if it happens in October, I think we have time for a rally into year end. If it happens, you know, or the first week of December, then maybe this year's somewhat of a write-off. So, but, you know, you have to use your technical tools and use what the market gives you to try to make money. Next slide. So again, this was from the Bureau of Labor Statistics, and it shows that there are more periods of disinflation than deflation. And as I say, we're not calling for deflation. Maybe David Rosenberg is, but we're not. And these disinflation periods always tend to happen after inflation spikes. So you can see in the recession period of 1982, you had a peak of CPI at almost 15%, and then it got down to 2.5% about 18 months later. So we can do the same sort of thing. It's just a matter of how high do rates have to go to reach that goal. So I'm confident that inflation is on its way down. Next slide. So what's happened between so far in this back half of the year? It's been a little more mixed. WTI did really well in the first half, but it's given back a lot of the gains. Gold, which was flat, has come off. The bonds have been a little flattish, and the equity markets have been up. And actually, the markets were down a lot yesterday, but still, even after that, the TSX at the end of yesterday is up 1.7%. The S&P is up 10 basis points. NASDAQ 174, and the Russell almost 5%. So it has been a better time for the equity markets since June 30th. And one thing that stands out is that the US dollar was up almost 10% in the first half, and here it's up almost 5%. And again, after yesterday, it was probably up a little bit more. And a strong US dollar usually causes problems in foreign markets. So that's where I think there'll be the bigger issues, is in the foreign markets rather than the US market. Even in Canada, like our Canadian dollar has been suffering. And I think it really comes down to the difference between how the household debt situation is in the US versus Canada. And really the housing market is a little more levered this time than the US market. Next slide. So again, this was to September 7th when we had to submit things for compliance. And it was a little more broad-based. But again, the sectors, there's still 5 sectors that are positive. Consumer discretionary is up 11.5%, energy 6.9%, utilities 3.9%, financials 2%, and industrials 0.5%. And if you think of that list, the only defensive sector is utilities that is there. So maybe, maybe a lot of damage did happen to the market in the first half of the year, and we shouldn't be as negative as we are if the utilities are the only defensive sector outperforming. But anyways, time will tell. We always like to let the markets tell us where to be positioned and what we want to own. Next slide. So this is put out by Goldman Sachs, and it just, again, it's generic, what tends to do well when financial conditions are tightening. And it's strong balance sheets, stocks with low volatility, which are usually the defense sectors, momentum leaders. Again, that can be anything. It's just whatever is going up relative to the rest of the market. So one area that has been doing well in over the summer has been the TAN ETF, or the solar stocks. And that's where the government's going to allocate, I think it's around $500 billion into the infrastructure bill. So they're not getting it all, but more money will be going to that sector. High return stocks and growth stability and margins. Small size and valuations, not so much, and same with growth. Next slide. So now we're going to show some charts and what our thoughts are. This is the Dixie, so the US dollar. I think the support levels that are 107 and 109. I know it shows that in this chart that the Dixie was pointing down towards 109. I think it hit 111 yesterday. And I think it's probably got a chance of peaking out around the 113 range. So a little more on the upside until it kind of stalls out. But for the moment, it still seems to have momentum to the upside. Next slide. So what does that mean for the Canadian dollar? Again, when we put this out, we have the support levels at 129.40 and 129. It got down to, what level did it get? 129.54, and then it bounced higher, and today we're sitting around 135. And I think it probably stalls here around 135, but is likely to hit that range of 137.50. So a little more weakness in the Canadian dollar is yet to come. And I think that's partly the bond experts sort of believe that Canada has one more hike of 50 basis points left in it, whereas the US, after yesterday's Fed hike, are still talking another 75 and 50 this year and 25 next year. So that'll leave the Bank of Canada in the dust if it's true that we only raise another 50. So the Canadian dollar is probably going to come under more pressure, probably even more than the 137.50 I have in mind. Next slide. So we were a little optimistic, I guess, hoping that bonds would kind of peak at this 330 to 350 range. We're hitting 370 today. But the trend is really much lower. And I still think with the idea of a recession coming, or a hard landing, whatever you want to call it, that the long duration bonds will have a place and can come off. The yields can come off a fair bit, especially if it works that the hiking of rates does bring in inflation hard, and the Fed sticks to its guns of wanting 2% inflation, then I think the 10-year bond will do quite well. And as I say, one of the services we like is Piper Sandler, and Nancy Lazar is looking for sub 2% inflation by the second quarter of next year. That would really do well for the long bond. When do we give up on that trade? It's really, at this point, I think equities have more downside than the bonds if yields continue to go up, say from 370 to 4%. I think equities will go down much more. Next slide. So you've probably heard a lot about the inversion curve this year, and I think coming into today it was minus 53, which is the lowest or the biggest since this century. And you can see past inversions have led to big declines in the market. And so I think there is risk that the equity markets can go a lot further. And I think what's missing so far, or what's not priced into the market, is earnings coming off. And again, using Piper Sandler, they're looking for $200 this year and $190 next year. And even if you give it a quad one type of scenario of a 20 times multiple, you get 3,800 to 4,000, which I think would be generous. Maybe that's where we are sometime in the back half of next year, but probably in between now and then, like I say, I'm hoping that it's sooner than later that we get the drop in the equities and then start rebuilding a base. But the inversion tends to point out that a recession is on the come, and equity markets are likely to succumb as earnings estimates come down. Next slide. Oil. So here it's been holding the support line just above $80. I think it would be higher if it wasn't for the strategic petroleum reserves being released. So I think once that comes to an end at the end of October, you're likely to see a bid to oil. I think they've even stated that they're a buyer at $80, and China is likely to, their demand for oil is likely to increase. And in the winter for Europe, it's likely the easiest thing for them to do is buy oil and substitute their natural gas for oil, since they don't have the natural gas coming from Russia. So I think as we get through October and into the winter, oil prices may have a bid. This way make it a lot more difficult for Powell to stop hiking rates and maybe have to accelerate. So there's a lot of things going on to keep our eyes on. Next slide. So this is a slide about volatility. And so I looked at it and I thought, well, what does it really mean? And to me, it really, I think you go through periods where markets are more volatile than not. And so the period after the great financial crisis, let's say from 2010 to 2018, the volatility was very low. And a lot of that was due to interest rates were low. And so I think the rates and liquidity can lead to volatility. So like the 30s, where I think one of the issues was lack of liquidity, and you'll see 1931 to 1934, each year is there plus 1938. And I think we're in a period of just more volatility. And it's not necessarily that we're in a depression. It's just that the liquidity is coming out of the market. And so things move much quicker. And there's been 88 days this year where the market has moved more than 1% up or down this year, which is, that's like 2 weeks every month. You're getting moves of 1% or more, which is a lot of volatility. And so I think if you're hoping that volatility disappears next year, it's probably going to be around for a while until interest rates start to decline. Next slide. Corporate credit spreads. This is one area that's kind of been surprising to me, like coming into today that shows 223 on the screen there. They're 213. And I would have thought with the backdrop or environment that we're in, we would get up and test that range of say 275 to 3%. And that's what I'd be interested in adding to corporate credit. So it's been surprising to me that we really haven't gotten there. And maybe it's true, as people say, the corporate balance sheets are in much better shape than they have been in quite a while. Next slide. Financial conditions are the wind. And really, if you look from late 2018 or right at the turn of 2018-19 till the end of 2021, financial conditions were moving straight down. You had the blip with the COVID crisis, but Powell injected all of that money. That liquidity drives the market. And so you had the tailwind for 3 years with I guess a burp in the middle. And now we've got a headwind. And you can see that empty circle. Well, actually, we've crossed above that par line or 100. We're 100.18. And again, if you look at the chart, typically when we hit those points, all hell seems to break loose, or you get some bad pin action in the market. Excuse me. So I think we are experiencing that now. Like yesterday was a bad day in the market, and today. So until it goes back below par, we're probably into rough water here. And that's why I'm hoping, or I'm of the view that maybe we get that low sometime, maybe it's in September or October, that can give us space or room for a rally into the year end. As you can see, that drawdown, we went from like around 99 or 99.80 to 99 in the summer, and that gave us a fairly decent rally. And so that's all we need to see is that rollover in financial conditions, and that can spark a rally in equities. Next slide. So these are a few charts I'm going to show from Cormark, my friend over there, has given me on the internals, and what they were calling for, or what he was calling for, was a bottom in the June was the bottom. And maybe you heard this through the summer, it was being talked about a breadth thrust where, oh, well, that's the next slide. This is just the number of new 52-week highs minus new lows, hit a point where it was similar to other lows except for 2008. On to the next slide. So it was a capitulation. Here is what they call the percent of on the New York Stock Exchange greater that hit the 200-day, the June 13th low. Capitulation is under 20%, and they hit that, and your market tends to go up once it gets out of the danger zone, which is 40%. Unfortunately, it did roll back down, and the only other time it really did that was 2008-09. It hit a low in 08, and then went through 40, and then got rejected, and then went back down into 2009. And I think that's probably what we're going to face here. Hopefully, it's like I say, I'm in the near term rather than long and drawn out. Next slide. So this was the breadth thrust, where you get 90% of the stocks going up, and the last line there says a fresh sell signal would be a break of 20%. Yesterday it hit 22%, so maybe with today it's broken and indicating a new sell signal. So that breadth thrust that signified the rally in the summer seems to have dissipated. And again, it kind of happened in, well, we didn't quite get the 90% in 2018. Anyways, the next slide. And so why it was appealing is generally when you get these breadth thrusts, the market goes up on average around 29% in around a 20-month period. So people were very hopeful in the summer that that was the low and things would improve. And we talked to a trader, just a pro trader that was set up through Piper Sandler, and he was of that mindset. And in the summer, you remember everyone talking about the Fed was going to pivot, and his 2 cents was, oh, the Fed did pivot when they raised 75 basis points in June, and then they only did 75 in July. That's a pivot because they didn't accelerate. And I thought to myself, that doesn't really seem to make good sense, but it worked for a while. That the summer rally continued. I mean, it went from 36.50 to 43.25. I think that's about 17%. Pretty aggressive rally, but I think on false hopes. And now it's given back quite a bit of that rally in the last 24 days. So anyways, the bottom line is, I think the summer rally was just a bear market rally. I think what the technicians were identifying in the early part of July was correct. It's like it was part of their process, but it now has dissipated and the downtrend is taking over. Next slide. Gold. As you can see, it's been in an uptrend since the 04-05 period, and I just think it's in this consolidation period. And part of that reason is real rates are now, I think it's 114 basis points, and back in the summer of 2020, it was negative 117. So, and the real rates only really started to go up in the spring of this year. So I think at some point that reverses. So in the meantime, gold is probably stuck in this range. It could be anywhere from 1,500 to 1,700, but it seems to be hanging in around 1,650 to 1,700 at the moment. I don't see that taking off until real rates start to come down. Next slide. So this time we thought we'd add a little thing on real estate, because I don't know if you read my weeklies, we mentioned from time to time that we keep expecting something to break, and maybe it's already broken and it's been breaking in front of our eyes. As you know, last September, a year ago, Evergrande in China started getting into problems, and then that spread to all the other developers. So China's been going through a problem in the real estate market. The US mortgage rates were 287, the 30-year mortgage rate, 287 back in December, and now it's, I think, 629 or 620 to 630. And in Canada, you can see prices have rolled over, I think 2.5% in the month of August, which was the biggest monthly decline on record. So the housing market is, for most individuals, their biggest balance sheet asset. And it may be, this is the most obvious that is what's going wrong, is real estate is under the wheel. And it's not just a Canadian thing, it's a US thing, and it's a China problem. And of course, one of the big issues is interest rates going up is making it less affordable for housing. So on the next slide. So rather than me giving my 2 cents, this is just data provided by David Doyle at Macquarie, and it's some data on the marketplace. But in Canada, I'm sure everyone listening to this call is quite aware of what's going on. So I don't need to really elaborate too much there. In Canada, 20% of the mortgages renew every year because we can only have a fixed rate for 5 years. Whereas in the US, you can get a 30-year mortgage. So some people are locking in 30-year mortgages at 1.8%. And well, anyways, the people that have done that are not likely to sell, because if they sell, they'll be buying a new house with a 6% mortgage. Next slide. So this is the Housing Affordability Index in Canada, and you can see it's really gotten out of reach in the last 2 years. So it wouldn't surprise me to see housing prices come down by 20%. Maybe that's a benefit to stocks, as some people losing money in real estate may put more money into equity, or for the area of the market that we like, more money might flow into the bonds. Next slide. So again, on the US housing, this is data provided by Hedgeye, Daryl Jones. And again, it's just that it's been coming under the wheel, and it has a big impact on the economy. Its ancillary drives 15 to 18% of GDP, and 3 to 5% is residential, and 12 to 13 is in consumption. So it's a big part, and if real estate is under the wheel or coming down or suffering, then it puts pressure on the economy. Next slide. And again, this is a little dated, but it shows how mortgage rates have been spiking higher this year. And I think they're back to 2008 and 2007 levels. So that always brings back bad memories to the real estate market. And so this is, again, another reason why, like we said in our quad 4, we've substituted REITs out and put in energy, as real estate is probably more susceptible here. Next slide. And mortgage applications have been coming off. So the demand has been dwindling and continues to to be slow. Next slide. So there's a piece on the China real estate, and it's put out by Noto Economics, a company that we subscribe to. And it's now saying that the cities or the municipalities get a lot of their income from selling property to the developers, and that's been drying up. And as far as what G is planning, he's going to help to try to get the completions done on the housing that's outstanding. But his focus is going to be on the supply side of the economy. So trying to get industry up and running at full capacity again. And his worry about China real estate is very, very little. He thinks it's more speculation than anything. So anyways, like, you can read that at your leisure. Next slide. So again, this is how we've been positioned for other quad fours. We tend to run a lot in bonds. In 2018, it was 46%, 41% in March 2020. We're around 43% today. Equities, we run light. We were 32% in December. And that's a bit different. Like going into the Christmas massacre, we were probably sub 20%, but at the end of the year, we had beefed it up. And in March of 2020, we were very low at around 22%. And commodities, mostly gold, in around 7%. And our cash level is high. And we're very similar to that today. As I said, bonds were around 43%. Equity is around 20 to 25%. Commodities is around 5% at the moment. And the balance is in cash. So it's fairly defensively positioned. Next slide. And you can see how we moved throughout the year. We started building our bond position, I guess, in April, May, and have been getting a little bit bigger throughout the summer. And our line of thinking on the long bond is that Powell will be successful in generating a recession. The inversion of the yield curve is telling us that, and that long bond yields will probably come down. It just may take longer than we've anticipated. In the past, it's been relatively quickly. But again, as you know how the markets move these days, in 2 days, you could get a move of, say, 4% in the bond market. I know it sounds like a lot for bonds, but that we think can happen. Just as in equities, they can move fairly quickly. Even in the currency markets, I think the Euro Swiss moved 2% today. So the volatility is high right across all asset classes. You have to be positioned ahead of time and follow your process. Next slide. So the bottom line is we think the volatility will continue, and as I mentioned, across all asset classes. Growth more challenged in 2022, but I think there'll be an inflection point in 2023. Inflation is decelerating in 2022. It could get sticky from month to month, but I think it's on the trajectory is downward. I guess oil is kind of, in my mind, the biggest thing to worry about, and maybe wages. The best growth quarter for this year is behind us. The second half of 2023 is likely to be better. And at some point, the market does start looking forward and anticipating, a recovery in the economy. The Fed will continue to tighten conditions, as they said yesterday. Probably 2 more hikes into the year end, whether it's 75 and 50 or something different, time will tell. So caution is warranted, but we're open-minded for change. And what I guess I really mean by that is if we get a quick down in the equity market, just because we're in a quad 4 doesn't mean there can't be a rally that we can participate in. But as of this day, we are not overly invested in equity. We're looking for further downside to get a little more aggressive. So I think on that note, I can start taking questions.
All right. Thanks very much, Ted. And we do have a couple of questions. The first one is just on U.S. real estate. So the question goes, with 30 to 40-year fixed rate mortgages now prominent in the States and low volumes of variable debt being issued, could the rate increases that we are seeing in the U.S. now have less effect on inflation now that increased rates are not having the same impact or effect on consumer spending, given that they don't have to renew at higher rates?
Yeah, so not being a specialist on real estate and how their markets function different than us, and I think when it just comes to inflate, like let's leave real estate aside, on the inflation, it's really about supply and demand. And because of the supply disruptions, we've had not enough supply, whether it's chips or washing machines or whatever. And so the idea of raising rates is to just make those products more expensive, and people put off that spending until a later date. And so demand comes to reach supply. And on the real estate, I suppose that its impact is less because the consumer balance sheet is much better than Canada. So there isn't, you're not seeing what happened in 2007, 2008, where people are handing in the keys of their property. They're able to afford their property. And again, because of the long duration of their mortgage, they're not being forced to take on a higher rate today. Now, obviously, there are some people, but for the majority, the answer is no.
Okay. There was another one here on oil prices. So you made some comments on that, but I guess the second part of the question is, what are your thoughts, short, medium, and long term, on Canadian oil producers?
Yeah, so the Canadian oil producers, I think, should do pretty well due to the fact that our view on the Canadian dollar is lower. So even if the crude goes from, say, 85 to 80, so let's say a 6% decline, and the Canadian dollar goes down, say, 3%, there's some mitigation there. So I think the effect for Canadian producers is a lot less. Now, obviously, if oil does come off hard, then they're going to get impacted. But again, I think there's a good chance oil prices start to go up in the typical seasonality for energy companies, which is October to May, or November to May.
Okay. Just a question about the asset allocation, in particular, the U.S. weight in the portfolio. So the advisor's asking, could you expand on foreign exchange at 44% being USD? Is that strictly cash, or does it cover other asset classes?
Yeah, it includes other asset classes.
Okay.
But we manage the foreign exchange to the weight we want. So that's an independent decision as to, so we could have, well, our maximum we can have in foreign content is 50% or 49%. So that's kind of our limitation as far as like bonds and stocks, but we can have more in foreign currency. So we could have, say, 25% in US bonds, 20% in US equity, and then an additional 10% in US cash, or basically a forward agreement.
Okay. Just back to oil for a second. Do you expect to pick up oil stocks like CBE or other US names now, or are you waiting for a sell-off here? Or is this the end of the trade? I guess they're talking specifically about more US specific oil stocks.
Yeah, we kind of have a mix of Canadian and US names. But it's mostly Canadian energy names that we have. Just because it's, as people know, the differences between the Canadian market and US market, like if you want to buy healthcare names, then you got to go to the US. There isn't any real healthcare names in Canada, except maybe Bausch, or if you consider the weed companies healthcare.
Right. I guess someone's asking for you to, bit of a crystal ball question here. From the quad slides, can you confirm when you think a move to quad 1 starts?
I think a real quad 1 is until the back half of 2023. But as you saw from the graph, it's kind of on the line. And if the difference between the growth is less than 1%, like I say, you can get that flip-flop. So I think we will see more flip-flopping next year, and again, more volatility in the front half of next year.
Right. Next one is, if we, I guess being Canada, lag behind with interest rates in 2022 and our dollar continues to drop against the US, then does our inflation not take off again based on imports? Thus, more rate hikes in 2023 in Canada as well?
Yeah, our currency will have an issue, or it can be a problem for fighting inflation for sure. But that's probably going to show up in food prices, which we have seen, right? Food prices in Canada on a year-over-year basis up over 10%. Because of, I guess, the shortage is probably coming out of California, and that's where we get our fruits and vegetables in the winter. On the other things, yeah, I guess a lot of goods that we buy in Canada are from outside sources, but the Canadian dollar has been strong relative to the yen and the euro and the pound. So maybe there's substitution for product. And we're even strong relative to the Chinese yuan.
Okay, so we are right at the top of the hour. There's a couple of more questions that we won't have a chance to get to, but I maybe I'll ask one more, and then for the questions that we didn't get a chance to get to, we can certainly get back to the individuals who asked them with a response. But maybe just for the final question, we did talk about the different headlines that we're seeing, whether it's EU energy crisis or the Ukraine war or China real estate or any of those issues. What of those, or if there's one that maybe we didn't touch on, would be of most concern of yours?
It's probably what's going on now, which is Russia mobilizing another 300,000 troops. And maybe the odds, like I'm no war expert, maybe the odds of a bigger escalation is around the corner. And they did sort of threaten the nuclear stuff. It seems like there's no backing, he's not backing down. And the Ukraine is fighting for their lives, right? They're fighting for their own territory or country. So no reason for them to back down. So maybe it gets a little more escalation than what the market is ready for.
Agreed. I think that's a concern that we probably all have, and we all often wonder about the information that we're seeing and what of that information we can trust. So it is a tad unsettling. So that is it. That brings us to 2:01. Ted, I just wanted to thank you on behalf of all the folks who are on the call today, and certainly the sales team at Arrow Capital for your ongoing willingness to do these types of presentations. They're very helpful to help us be informed on what you're doing with the fund. And also, I think we get a lot of positive feedback from the field, from the advisors who are able to attend as well. So with that, we can wrap up the conversation for today. As always, if you have any more questions, please reach out to your rep at Arrow Capital, and we will do our best to get information back to you. Thank you so much for attending today, and look forward to seeing you out in the field.
Thanks a lot.